ride-sharing is going to be amongst the hardest hit sector within the broader tech sector. What we're seeing is, massive decreases in driver pay, which might prompt some sort of government action. And of course, it's going to hit the revenue of these companies as well. Whether or not people could muster the political support to save some of these companies which have never been profitable in their history and have in fact never even shown a path to profitability, I think that would be kind of a tough sell on the governmental level.
That was going to bring me to my next point there. A number of these companies, as you rightly point out, like Uber, have never managed to be profitable. So how does a company that isn't profitable survive in an environment where fewer and fewer people are using their services? I mean, just to use the airlines as a reference again, airlines in North America, for instance, came into 2020 in the most profitable position that they've been in many, many years, yet now are on the brink of collapse if they don't receive government help.
That's right. And, I think the big issue that these companies are going to face is cash supplies versus the length of this potential downturn. If you look, just to use Uber as an example, because it's just so easy to point at, their loss last year was on the order of $8.5 billion. On an operating level, if you want to be charitable and say, fine, let's take their adjusted EBITDA numbers, it's just short of $3 billion. Now, they do have a large cash holding, which should get them through that time, but it's not infinite, particularly if they want to keep supporting the drivers that they have on their rolls, which is a challenge that's not often discussed. Because if drivers move away, they could go do something else potentially. And also if they want to continue to feed the businesses that they see as driving their growth in the future. And these are growth-focused businesses. They can't give up businesses like maybe a fintech or food delivery that drive the growth to keep their investors happy. So once that growth diminishes, they're going to be in a lot of trouble in terms of burning cash.
There are a number of analysts that, when we refer to Uber, and I guess we'll just keep talking about Uber, but that criticize Uber for having such a diversification, for going into things like Uber Eats and food delivery, and that when you looked at Uber vis-a-vis Lyft, Lyft was in a better position given that it wasn't so widely spread into a variety of businesses. But could now that be a saving grace for something like Uber? Because as you would well know, and as all of our viewers would know as well, deliveries have, of course, shot up in this time of social isolation and social distancing.
Well, at the risk of sounding like a pessimist, I would say this. If you look at Uber's core businesses or Lyft's or Grab or Gojek or looking anywhere in the world, as they've grown those businesses, they're subsidizing them heavily. So every dollar of incremental revenue costs them about $1.20 or more to actually generate. So in fact, the fact that we're all ordering food in at home, and as you can see, that's where I am right now, could actually diminish the cash that these guys have, because they might, and we'll find out soon, be losing money on every order. But if you look at the financials of these companies as they stand today, that's in fact the case. Now, a saving grace might be the fintech area, where some of these companies are going into, but they're no longer competing against taxis or food delivery services or local restaurants. Now they're competing against major financial juggernauts who are also pushing into fintech. So maybe not quite as easy to generate cash there.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.